One of Wall Street's most respected economists just released his 2026 market forecast. And if he's right, everything you've been told about where to put your money in 2026 is wrong. Dr. Ed Yardeni studied economics under a Nobel Prize winner at Yale. He worked at the Federal Reserve. Barron's magazine called him the Wall Street Seer. We've been following him for nearly 30 years. His target? The S&P 500 at 10,000 by 2030. That's roughly 43% above where we sit today. But here's what most people are missing. Yardeni says the easy money from loading up on tech stocks is probably behind us. The playbook that worked for the past decade, it needs to change. Today I'm going to walk you through Dr. Yardeni's, we call him Dr. Ed, complete 2026 market outlook. We'll cover why he's reducing his bet on big tech for the first time in years, and where he thinks the real opportunities are hiding, and what his roaring 2020s thesis means for your retirement portfolio. So let's get into it. First, let's understand Yardeni's big picture thesis. He believes we're living through a period similar to the 1920s. Think about it. Electricity and automobiles transformed the economy back then. Today, artificial intelligence is doing the same thing. Yardeni calls productivity the fairy dust of the economy. When companies get more done with the same effort, they can pay workers more, keep prices stable, and still make higher profits. Everybody wins. And despite everything we've been through, the pandemic, supply chain disasters, inflation, tariff battles, the U.S. economy keeps hitting new records. Real GDP, that's the total value of goods and services adjusted for inflation, sits at an all-time high. Consumer spending per household also at an all-time high. Yardeni sees this resilience as proof that the economy can handle whatever comes next. His specific target, the S&P 500 index earnings, should be reaching $500 per share by 2030. And at a reasonable 20 times multiple, that gets you to his $10,000 target. Now, here's where it gets interesting and where most investors are getting this wrong. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, NVIDIA, and Tesla have dominated returns for years. But Yardeni sees a structural change happening. These companies used to operate like separate kingdoms. Apple owned mobile, Google owned search, Amazon owned e-commerce. They generated massive cash, still do, without spending huge sums to defend their positions. AI has changed everything. Now competitors like DeepSeek, a Chinese low-cost open AI provider, and Google's own Gemini can challenge any of them. The walls protecting these giants are crumbling. And here's the number that really matters. The Magnificent Seven invested nearly $265 billion in capital expenditures in their latest fiscal year. That's up 27% from the prior period. When companies spend more on data centers, equipment, and talent, less money flows to profits and dividends, less money for you. But the Magnificent Seven's profit growth is expected to slow, but only to 18% in 2026. That's down from higher levels. And it's only modestly better than the 13% growth expected from the other 493 companies in the S&P 500. For the first time since 2022, most of the Magnificent Seven actually underperformed the S&P 500 in 2025. Only NVIDIA and Alphabet beat the broader market. This is why Yardeni recommends moving tech and communication services from overweight to market weight. Don't abandon these stocks. No, not that. But just stop betting the farm on them. And that's what you're doing, whether you're in an index fund or in most of your portfolios. If you've owned them, they've grown so large that they're overweight. So he's saying, cut back on that overweight. So if not big tech, where does Yardeni suggest looking? He points to the impressive 493, the remaining S&P 500 companies that have been overshadowed by the Magnificent Seven. 3 sectors for him stand out. First, financials, especially regional banks. Their smaller banks benefit when the economy grows steadily. They make money lending to local businesses and home buyers, and when interest rates stay elevated, as Yardeni expects, banks earn more on their loans. Second, industrials, particularly mid-cap companies. Mid-caps are companies larger than startups, but smaller than the giants like Boeing or Caterpillar. They provide the equipment, the machinery, and services that keep the economy running. They tend to outperform when growth is steady. Third, healthcare, with a focus on biotech. Biotechnology companies develop new drugs and treatments, and when larger pharmaceutical companies want new products, which they are coming up on what's called a patent cliff now, they often buy these smaller biotech. So M&A activity, mergers and acquisitions, can reward biotech investors in this type of environment. I had a client who was 90% in technology stocks. When I showed them this concentration risk that they're having, they couldn't believe they'd been walking that tightrope without even realizing it. Yardeni also suggests looking beyond U.S. borders. U.S. stocks now dominate global indices at historically high levels. International equities stocks represent only 20% of the world index, their lowest weight in 40 years. The long-term average is nearly 50%. The stay-home strategy that worked since 2010 may need some revision. The U.S. dollar has weakened recently, boosting returns on foreign investments when converted back into dollars. International stocks actually outperformed in 2025. The Morgan Stanley World Index, ex the USA, gained 29%, beating the S&P 500 16% last year. Specific opportunities that Dr. Ed highlights are Spain's banking sector and emerging markets like Poland, Brazil, and Mexico. What about bonds, you might ask? Well, of course, you know that we don't recommend you own any bonds for your retirement portfolio, except for the money in very short-term bonds that you need in the next 3 to 5 years. Many investors expected yields to fall sharply after the Fed started cutting rates, but it hasn't happened. Even though the Fed cut rates by 175 basis points, that's 1.75%, since September of 2024, the 10-year Treasury yield has stubbornly stayed above 4%. Think of it this way. The Federal Reserve controls short-term interest rates, but the market sets long-term interest rates based on expectations for growth, inflation, and even the budget deficit and the confidence in assets in the United States. So Yardeni expects the 10-year Treasury note to trade between 4 and 5% for the foreseeable future. The takeaway, don't expect a return to the near zero yield era. That's not happening. The economy is growing at a pace that supports higher bond yields. And that's actually good news if you're looking for income. 4% or better on government bonds is meaningful. But like I said, if you're looking for income, it's much better, especially for a retirement portfolio, much better to be in stocks for the long term. Anyway, so what should you do with all this? Yardeni's analysis gives us a framework. Not a guarantee, of course. Markets can surprise even the most experienced observers, but his core message is practical and we're heeding it. We've already reviewed our tech exposure. We've brought down the Magnificent Seven in our portfolio. We did that at the end of last year, and we rotated into some mid-cap stocks that have either been in the portfolio or been on our list for a long time. So if technology and communication make up more than 45% of your portfolio, consider rebalancing. Look beyond the headlines. 493 other S&P 500 companies may offer better risk-adjusted opportunities in 2026. We are finding plenty of undervalued quality companies in this space, small and mid-cap companies in the United States. And as we're doing, we're considering geographic diversification. U.S. stocks dominate at historically high levels right now, so we want to set realistic expectations for bonds. yields are staying elevated, and above all, stay invested. Yardeni views corrections as buying opportunities, not reasons to panic, just like we've been preaching, well, forever. The economy keeps surprising the pessimists. Dr. Ed's roaring 2020 thesis suggests the good times may continue, but the next phase rewards those who look beyond the obvious winners. So if you found value in Yardeni's analysis, you're going to want to watch this next video. It breaks down exactly how to rebalance a portfolio that's become too concentrated in tech stocks, step by step, without triggering unnecessary taxes. That's the piece most people miss. Watch it next. See ya.